Hi, everyone. Thank you for joining our webinar. We'll get started here in just a minute. We're getting everybody into the room as I speak. I'm Missy Gilliland. I'm the Director of Learning and Development. We're really glad you could join us today for our third part of Ready to Grow webinar series. This is our strategic series on growth. Today, we have two of the best experts in the business to share their knowledge with you. I'm going to be putting the handout in the chat for you so you can follow along with the presentation. If you have any questions, feel free to use the Q&A as we go through the presentation. With that, I'm going to turn it over to Christy to go ahead and introduce herself.
And I will make this quick because we have a lot of content to cover with you in a short amount of time. So hi, everyone. Glad to be with you this morning. My name is Christy Lang. I am the Director of Data Analytics. And I guess it's afternoon for many of you. So it's still morning here on the West Coast. But I'm here with one of my favorite partners in webinar crime, Mike. So Mike.
Thanks, Christy. And I will try to keep this as quick as possible as well. My name is Mike Simione. I am a Managing Director in Financial Consulting with SimiTree, and also love presenting with Christy, and also good morning to everyone from the West Coast, with it being 9 a.m. for us, even though it's noon for all of you on the East Coast. So thank you for joining us today. You know, if you've been to our series so far, we've kind of talked about the strategic plan for growth, and that's culminating today with, okay, we're going to expand, we're going to grow in some way. What does that look like? What's the strategy behind the implementation of executing that growth strategy? First, we're going to talk about what the best option is to build or buy. And we're going to talk about setting realistic expectations upon that growth strategy. And then how do you build a financial plan? And yes, with these, you'll need to do pro formas, but we're going to go kind of more into what data should you be tracking and building as you go through either a build or buy plan throughout this process. So we're going to start with a poll for everybody. We're only put it up for about 30 seconds, but if you're attending this webinar, I assume there is some plan or strategy for growth for your organization. And we would love to have your responses to see what your plan is currently. Is your plan to build? So start a new agency from scratch, new branch from scratch, or build out in a new territory. That could take many different forms, or to buy an existing provider that's out there to expand the growth into a new geographic market, as an example. So don't have any participation yet, but would love to get some people to vote. Or I don't know if there's any participation yet. I don't know if I can see that.
We actually do, Mike. We're at about 85% are looking to build. And then, well, it just changed. So now we're at 81% to build and 19% to buy.
Right.
Interesting. Okay, so we're going to cover a little bit on both, but good to know that the plan right now for most of the participants on this call is to build, and we can focus more from there. So when you're looking at build versus buy, which strategy should you pick? And there's a number of different factors that you want to take into account. We're going to start with the buy, acquiring an existing agency, and some of the factors that are going to, you know, contribute to your decision. Looking at the referral network of the agency in there. Is it a strong referral network? What does the market look like? So we're looking for, if we're going to go this strategy, probably looking at markets that are a little bit more concentrated, have a bit more loyalty within it. Where it's harder for you to gain a substantial market share or a significant market share for your agency. If you're acquiring an agency, you got to look at the staff that you're acquiring. So you want to look across not just your direct care and clinical staff, but your administrative staff. So there's that evaluation, and you know, looking at the market as well. What is hiring going to be extremely difficult in that market? In addition, a lot of CON states, you know, this strategy is a little bit easier because they've already, you know, have that certificate of need and have already gone through that that process. And then the capital that you need to acquire an agency, you know, if you have the capital and cash on hand in reserves. Or do you need investment, you know, owner investment, management investment, private equity investment? What does that look like? You know, where does that capital, loans, lines of credit to purchase that agency? If you're going the de novo route and building from scratch, you want to, you know, do you have the expertise to be able to do this successfully? So can you go into a new market, gain some market share? Have you done this before? You know, do you have experience, and does your leadership have experience building? What's required? What are the steps? Do you have the patience and the appetite to go through that process? Because it's going to be multiple years when you're going a de novo strategy, most likely before you turn a profit. So you have to be able to willing to eat that cost and eat those losses within your current business model, and have the patience for that market to grow. What you want to look at is the de novo strategy tends to be a little bit easier in more fragmented and dynamic markets, market where there's a bit more volatility year over year in the market share and a lot more fragmentation. You could have one dominant referral source or provider that has a market share, but then a lot of other agencies that make up very, very small contributions where it's easier for you to gain market share and earn and, you know, take away from the existing providers that are in there. Also at times, and, you know, last year I think was a good example of this, where there was, in the last couple of years, there's been a bit of a slowdown in the mergers and acquisition market that we've seen. If there's no agencies available for purchase, I've seen a lot of national chains that we've worked with over the last year go the de novo growth route over the acquisition route because of that slowdown in agencies going up for sale. But I think starting out in 2024, we're seeing agencies come up on the market now a bit more frequently. So this is all the ebbs and flows and the patterns we see within the mergers and acquisition market. You know, you have to be patient, and with that patience, slower overall growth goals. You're not going to be able to grow at the rate that you would if you acquire an existing agency that already has a market share, that already has a sales and marketing staff. You're going to have to build those relationships from scratch. And, you know, do you have referral relationships? Say you're working with a partner hospital. Does that partner hospital have a, you know, a sister hospital or another hospital in a new market that you can leverage your relationships, your contracts with to extend? So if you're in working with a regional or a national chain hospital system, can you work with them and extend beyond your current market into one of their other, you know, satellite markets that they may offer services in?
Kind of get a jump start there. Yeah. All right. If you've joined us for the previous couple of webinars as part of this series, you may have some familiarity with this report. We've shown you before some of the analyses that we offer to our clients, looking at the providers operating in a particular market, what their market share looks like, how that's trended over time. And wanted to use a couple of examples of two different markets. These are real data, so that these do represent actual areas in different parts of the country. This is an example of a more concentrated market. So when Mike was talking about why acquiring an agency might be a better choice, a market like this, acquiring an agency may be a better strategy. You've already got organizations that have a pretty strong share in the space. They already have some loyalty from their referral sources, and it's going to be harder for you potentially to break in as a brand new agency into a market like this. Where on the flip side, the market that we show on the bottom example, we have a ton of agencies that are all capturing pretty small percentages of the market. We tend to see this in bigger markets where 2% of the market is still reasonable revenue. But here's an example of a market where it might be easier for you to start chipping in, getting into the conversations, finding your opportunities to grow. And also we mentioned this concept of dynamic markets. I mean, here with these identified market positions over the last few years, you can see how we have several agencies in the top 10 today in 2023 that came from out of nowhere just a few years ago, came from 68th position or 309th position up to 5th in just a 4-year time frame. So it shows that there's more openness and opportunity for new entrants to make their way in and start to find their foothold.
So when you're looking at the acquisition versus the de novo route, you want to consider the costs. So in an acquisition, you're looking at the market value of the agency, and that market value is typically, you know, 8 to 12 times the EBITDA. So the earnings before interest, depreciation, taxes, and amortization. Currently, that market value does range, you know, 8 to 12 times EBITDA is the market value for agencies, typically with hospice being on the higher end of that versus home health currently. The cost of due diligence. So when you're going in and buying an agency, you want to do your financial and your clinical due diligence. And so financial, you want to make sure that there's a quality of earnings review. So you're looking at the earnings. And clinically, you want to make sure that there's compliance. You want to make sure there's no risk in the agency. So you have to spend money to have those due diligence performed, but also then look at the potential cost and risk that you could face from potential paybacks to Medicare if there is things that you find that are out of compliance, and how much are you willing to risk. You got to look at brokerage costs because, nothing comes free. So you have to have someone there to broker the deal, and, that's going to come as an expense. And then after you actually acquire, the integration expenses. There's bringing benefit and payroll plans together, technology changes, financial systems, consolidation of systems. There's cost savings, but there's also going to be some integration, some time where you're bringing everything on and you're not going to be able to transition all of your patients, all of your billing over. What does that look like? One of the things that SimiTree frequently does throughout these integration process will help agencies clean up old billing and collections from the previous EMR so that the staff can transition over to the new EMR and work completely in there. So everybody's working in one system and not trying to straddle between two, but that comes at an expense. So any of those integration expenses. Now, de novo, there are expenses that come with certification, especially if you're going into a CON state, but you have to realize that you're going to not only have costs with the certification, but also pre-certification patient care. So you don't get Medicare certified immediately. You have to demonstrate a certain amount of patients census on service for an extended period of time. And there's costs going to be associated with that. You can't always go back and bill for all of those patients. Big expense when you're doing that de novo strategy, marketing, building those relationships, getting your liaisons and your sales staff out into the field, building a relationship with referral partners, with physician practices and hospitals in your market. Obviously, if you're going to de novo, you're starting generally from scratch. Like I said, you may have some relationships previously, but there's going to be a lot associated with that marketing, as well as recruiting and training. So you're building that clinician base from scratch. We know how competitive it is right now in the skilled nursing market for staff. So recruiting, it's going to take a bit more to convince someone to come over to a starting agency, a new agency, versus being where they're existing, as well as the training that goes on if they're transitioning systems, transitioning roles, etc. You need to have the de novo if you're setting up a new branch or a new provider. You need to have a physical location, so there's capital costs that are going to be associated with that, with rent, utilities, and capital related costs, and then the cost to acquire vendor contracts. So if you're starting from scratch, ideally, you've got some of these already set up, but they need to be extended now to your new branch or your new provider. But all those costs need to be considered when you're deciding between which strategy you want to go with.
Some thoughts when it comes to setting up realistic expectations. The approach to this set of analyses is a little bit different if you're acquiring or you've got a couple of additional things to think about. Looking at the organization that you're acquiring, what their current volume and recent trends have been, but also some assessment of transition risks where you might be losing opportunity or potentially even gaining opportunity, and how that would impact your projections for the future. But regardless of if you're acquiring or going de novo, you're going to be wanting to think about market volume, what sort of patient volume is out there right now, what market referral sources you might be able to work with, how you might be able to start making inroads with those different referral sources, and what that means in terms of your volume. And kind of the same consideration when you're thinking about your key competitors. Are there some that you can make progress with, chipping away, potentially transitioning some of their volume to your organization more quickly, or is that going to be a steeper road to climb? So we have an example here of thinking about if you're acquiring an agency, what sort of data you want to be looking at for projecting how your volume is going to look and what your financial model is going to look going forward. A lot of organizations are looking at revenue. Oftentimes we're just looking at a yearly revenue. We recommend that you break it down and actually look at recent trends. This is an example. This one's totally hypothetical. This one's not actual data. But what it shows is 2 annual revenues for 2022 and 2023, despite the labeling error there that I just noticed. 2 annual revenues that are almost identical, but you can see how in the most current data, we've actually had a drop in quarterly revenue. If you see 2 annual numbers that are identical, that might lead you to some inaccurate projections about what's going on given, or what you're going to see next year, given what the recent trend has been in the past few quarters. So here's an example where you want to think about the fact that we've had a decrease in revenue. understand what has been driving that decrease in revenue. Is it actually a decrease in volume, or might it be something like a change in the payer mix? That we're having more Medicare Advantage patients and fewer traditional Medicare patients, and that's having the impact on the revenue. All those data elements, this is just kind of tip of the iceberg, are going to influence how you look forward with those financial projections. And then when we think about transition risks, this is where you're trying to assess the less data-driven part of the conversation, but trying to then model it in the data that you have for your organization. Do you expect that you acquiring an agency is going to have a big impact on referral sources, or are you just going to be able to step into that role pretty smoothly? Are you expecting changes in staff, especially your key growth leaders or your key sales organization leaders? We recommend that if you are losing a strong sales member, that you should anticipate a 50% drop in the referrals that can be attributed to that sales leader. What is your competitor's reaction going to be? Are they going to respond aggressively and try and take advantage of the transition, or are they just going to kind of stay status quo? All those can influence how you are thinking about setting up your realistic expectations for next year or whatever point in time you take over the acquisition. So again, whether you are looking at acquiring an existing agency or doing something as a startup, we want to think about the market opportunity. This is another example of data from our market analysis application called the MAP, or Market Assessment Platform. I did have a question in the Q&A about this data. The data that we use for this is pulled through the Medicare claims, and we do make licenses to this data available to our clients. We're not the only one. There are other organizations who do this. And then some agencies out there are doing something that's a little bit less comprehensively, a little bit less of a comprehensive view of the data, because they're not working with actual direct claim data, but they do have some level of data that they're gathering from market intelligence locally. So there are a few different options for getting your hands on data. If you haven't joined us for the previous webinars, we talk a little bit more about that in those past two sessions. But in this view of the data, we're looking at the top referring hospitals in the market. We're looking at how many admissions they are actually sending to home health. And then we're taking a look at understanding what that mix of patients looks like based on their home health clinical group. So we use this data to help us understand anticipated revenue opportunity from each individual referral source in the community. So we're looking at types of patients. We're also looking at overall volume. And understanding where that volume lives, where it exists today, what sort of potential we have access to. We may take a closer look beyond looking at the referral numbers overall. We may be looking at specific hospitals or specific physician sources of referrals, and then which agencies they are actually referring to today. So that's what you have an example of here in this view, looking at one particular hospital, the volume of patients they're referring to home health overall, but also what specific agencies are receiving those referrals today. The overall volume helps you understand where the opportunity is and how much opportunity you can expect. I heard a good saying the other day that you want to fish where the fish are, right? So just knowing which hospitals are referring patients to home health today or which physicians are working with home health, that's kind of that high level view. And you may break it down by patient mix to better understand the reimbursement opportunities from a particular referral source. But here, this helps us better understand what might our opportunity be to step into a relationship with individual referral sources. We know where the referrals are, but in this particular example, we've got a hospital that has 73% of their home health referrals going to one particular agency. We probably can't expect to step into that relationship and quickly be acquiring 10 or 20% of the revenue of the referrals from that particular hospital, because they clearly already have an affinity or a referral relationship set up that might be harder to disrupt. If we see other numbers, like let's say the top referral source from a particular hospital only receives 40% of those referrals, then that, I think, opens up more opportunity for us to expect that we might get a higher volume of referrals.
Those realistic expectations that Christy's talking about setting really are important when you come to financial modeling, because here is where you understand how long it's going to take you and what point do we turn a profit. And so when you're going the de novo route, you want to understand your costs. So if you're opening up a new branch, you need to know what it's going to take for you to be profitable at that branch, what census. And just because you're moving into a market that has a, higher revenue per patient day, that doesn't always mean that the same census is going to yield profits, because or at a certain census is going to yield profits. So on the right, I did a break-even analysis for two different hospice agencies. Basically, two hospices, both looking to go into a new market with their current structure. And, their current census at being at 456 versus 256. That break-even analysis taking into account revenue per day and direct cost per day, and that fixed administrative cost, which we expect to change a little bit, but to do a break-even analysis, you need some kind of fixed cost in there. You'll see that the smaller hospice with the lower revenue actually has a lower census for break-even, because they have that lower fixed cost and that lower direct cost per day. So realistic expectations, getting to a ADC, average daily census, for a hospice of 148 is much more realistic inside of 3 years versus getting to a average daily census of 277. Now, hospice A, before they go into a new market and do a de novo strategy, they have to look at their cost structure, their current administrative cost, their current direct care cost, and assess, okay, we can't go and do the same thing in another market and be successful. Or unless we get a census of 277, which may not be realistic through a de novo, especially in a highly competitive market. So that's why that realistic expectation is key, because you need to know, and ideally, most de novos, we're looking at a goal of 3 years would be ideal to turn a profit. So you can see on the graph on the left that it's going to take longer, at a census, that census range for that net margin to, yield what needs to be yield. Obviously, that 26% that we're getting at the 350, likely there'll be some extra admin costs that get added at that point. But for these purposes, you'll see that actually, from a cost management perspective, Hospice B does a much better job and is much more ready to implement their current clinical management, back office, and clinical structure in a new market versus Hospice A. Hospice A probably needs to do some cost management before they look at this de novo strategy. Otherwise, like I said, they're going to need a census close to 300. We rarely see de novos have that much success that quickly, unless, they're able to ramp up through referral relationships very, very quickly and staffing very, very quickly. So that's the financial modeling you want to do on a de novo, is that break-even analysis. For an acquisition, going on the next slide.
Oh, sorry.
No worries.
I just we got a confirmation, a yes in the Q&A. So
okay. And so when you're looking at an acquisition, you want to look at, okay, what are the financial synergies post integration? What economies of scale are we building through an acquisition? So what we also want to do is, depending on each provider's current structure, are they insourced or outsourced, using insourced or outsourced services? So is your billing and collections insourced or outsourced? Is your OASIS and coding insourced or outsourced? So if you're using, is your talent solutions, your recruitment process insourced or outsourced? And what is the best choice in each of those areas based on the potential cost and return on investment with those services? In addition, ideally, if you're doing an acquisition, you may be able to consolidate office space. So if you're doing some kind of integration between providers, you're able to reduce cost through rent and other capital related expenses. And then especially, as I mentioned earlier, vendor contracts and technology expenditures. So you may have 2 different DME suppliers, 2 different medical supply suppliers, 2 different EMRs going down to 1. So even though there's integration costs, in the long run, there is going to be cost savings because you're going to be only on 1 system and only working in 1 vendor in most of these areas. So what are those synergies or potential synergies? One of the things that SimiTree does in our assessments is we look at the staffing. And so when we're bringing 2 agencies together, we're looking at, okay, what is the current FTE volume for each role at the organizations? What's the total? And then what's recommended best practice based on staffing productivity benchmarks? And I did revenue cycle team here to calculate the synergy for the director. When you're bringing 2 agencies together, there is each a director at 1, really only need 1 leader to oversee this department. For management, either we was 3, now you need 2. But we get down to the level of the people actually performing the functions. So you see the ability to go from 16.5 current FTEs doing billing and collections down to 14. And then the savings that's associated with that, $123,000. So based on how much a biller can process per day, per month, per year to be both between Medicare and non-Medicare revenue, because obviously there's different functions and different ratios there. Same thing for authorization and verification. Medicare, that process is pretty streamlined, but if you've got a high non-Medicare volume, you're going to need more individuals doing that authorization process. Same with medical records, those individuals that are following up on orders and supplemental orders there. So looking at those potential savings of bringing two agencies together, that acquisition, you're looking at potential synergies in staffing, of potentially 14 FTEs for these two organizations coming together and almost $800,000. Obviously, these are two larger organizations coming together, but even if you're acquiring a small provider, there are potential synergies that are out there from a staffing perspective that provide that cost savings. So important that you model that when you're looking at your pro forma and your financial forecast. And then another thing that, we like to look at when we're doing those acquisition and that financial modeling is looking at the synergies across each department. So, okay, what does the cost represent for each department as a percentage of revenue? This is a healthy way to look at certain areas and certain functions within the organization to be, are we spending enough in each area or the requisite amount? And some of the examples I'll give is if you have a higher information technology than the benchmark, that's okay. But we would expect that you're spending more in technology. You've got automation, you've got systems that are reducing bodies and people. So some of your other areas, maybe in revenue cycle management, maybe in quality and compliance, other areas, maybe you're able to reduce staff because you've got a little bit more automated in terms of financial reporting, et cetera. But what we look at is what was the cost as a percentage of revenue before the acquisition and then after the acquisition. So with those synergies of those staffing costs, those vendor contract costs, what are we able to reduce? What did it represent as a percentage of revenue before versus what it's going to represent as a percentage of revenue for the consolidated whole organization? Now, we won't be able to realize all of these cost savings and synergies immediately. It's important that when we're doing this financial modeling and building out that pro forma, we phase this in over a year, 2 years, potentially even up to 3 years, because you're going to have patients and billing and claims on an old system, as I mentioned, that you're going to have to follow up on. So you're not going to be able to transition from one EMR to another immediately. There's going to need to be a transition process. You're not going to come in and lay off a lot of staff. You're going to go through an integration process. Eventually, yes, you will likely reduce staff at some point, but there's going to be an integrations process because you may lose existing staff through that integration. And you also may identify expertise and really talented individuals in that acquisition that you want to retain and keep in your organization. So you want to assess those individuals before you go through this streamlining process. Space occupancy, your lease agreements. How easy is it for you to terminate those lease agreements? Is there a way to get out of your lease at the end of a year, at the end of 2 years? That's going to be less expensive than, potentially if you have a 10-year lease on a space that you're looking to reduce. So there's a lot of factors in here. You want to look at what it's going to be at the beginning and the end, but when you're doing the pro forma that you should do through any acquisition or through any de novo, you want to make sure that everything is phased in. And like we said earlier, you have realistic expectations for when these synergies can be realized, or if you're going to de novo strategy, when you can expect your volume to grow.
I think some of these tasks may get more efficient. You may have higher productivity, lower cost structure in the long run, but you may actually have an increase in the cost structure in the short run as you're adapting and learning. So we want to quickly poll everyone once again, just to see if anybody's opinions have changed as we wrap up today's presentation on thinking about this. So Missy, can you launch the second poll, please? And just want to put in a word, we went through a lot of information really quickly here. As you might imagine, it could take, we could easily talk an entire hour just about doing a break-even analysis, what you should be thinking about and some details to that structure. But we wanted to pack some high-level content into a short amount of time. So hopefully you felt like you got a good ROI out of your half hour here today. And we do appreciate you joining us. So anybody's opinions changing?
Yeah, a few changes. So we're seeing now a 69% to build and 31% to buy.
All right.
Okay, so just reduction about 10% on the build based on what we presented today. Interesting.
Yeah. And we're not holding you to any of these answers. So you're free to do whatever you're going to do. And as you think and explore more, you may change your mind 14 times in the future.
You may not dictate the choice. The market may dictate the choice. The availability of agencies to actually acquire may dictate the choice of which route you go. But it's good to know what you can do and what you're capable of, and then also how to plan for these.
And I think to wrap up today's conversation, we just like to say, we scratched the surface here. If you would like to have a more in-depth conversation about anything we've talked about or anything else that's kind of itching at your brain, we have a whole bunch of experts who have spent a lot of time in the industry doing a lot of the things that you're probably trying to do right now, that would love to talk to you and see if there's anything that we can do to make your lives a little bit easier so that you can focus on taking care of your staff and your patients. That was just a snapshot of a few of the things that were specifically tied to our conversation today. And as we are almost exactly wrapping up on time, just our contact information. And if you didn't watch those first 2 webinars in the series, but you'd like to go back and take a look at them or look at other content available through a medium like this, please check out our webpage and see what piques your interest.
Excellent.
And Mike, Missy, anything to wrap up here?
No, thanks everybody for their time. Greatly appreciate it. And yeah, I almost made it under 30 minutes. It's close.
Excellent webinar. As always, Christy and Mike, great information shared. And like Christy said, if you have any questions, please feel free to reach out to us. We will send a follow-up email that will include a link to this webinar recording so you can review it as needed. With that, we always appreciate you joining us, and we hope to see you at a future webinar. Mike and Christy, thank you so much for your time.
Thanks, Missy.
Thank you as always.
Thanks, Christy.
Thank you, Mike. Talk to you soon.